Cool. So thank you everyone for coming today. So the goal, I really appreciate people kind of showing up to, a webinar to learn about modeling safes, which can be a fairly tactical, detailed thing sometimes for people. But my goal today basically is to kind of cover pre-money and post-money safes and dig into some of the details associated with them. The slides for today, as well as the example model that's part of it, are available. The URLs are in the chat, and as well as directly on here on the first slide. You can go and download the PDF of the slides, and you take the spreadsheet, the example spreadsheet, copy to Google Drive or down to Excel, and kind of use whatever you want to. There are some additional videos I will be adding as a kind of additional materials that covers each one of the sheets in the worksheet. I haven't finished recording all of them. I'll do them later. So just one note, if you download it, you might want to come back a little bit later. I'll send a note out to everyone who attends to say, hey, I finished all the videos. So you might want to come back to a little later. So let's get started. So first off, I'm Taylor. I did my BA in economics at University of Virginia and my MBA in finance accounting at Tepper School of Business at Carnegie Mellon, actually, which is where I live in Pittsburgh. I've been a bunch of different things throughout my career. We used to work as a VC, worked as an EAR for Venture for America, ran product and forecasting for e-commerce companies, strategy consultant, business development, private equity, professional photographer. But for the last 5 years, I've run Foresight. And so Foresight is like a boutique product and services company focused on financial modeling and forecasting for startups and funds. Now, I care about modeling because I've been building models for companies for 25 years. And I care about modeling because I believe the models can help us make critical business decisions, even if the models themselves are not always right. And I know it's a common complaint about models is that you use them to forecast something doesn't actually happen. My point is correct. Like forecasting the unknown, especially in an incredibly immature kind of companies, as they're kind of very early stage companies, is going to be hard. It's very hard to forecast that. The goal of the model is not to be right in the forecast, but the goal is to be an analysis tool to understand how things change over time. So the goal, my learning objectives for today are to a basic understanding of how to model cap tables and basic terms as part of it, learn how to model issuing and converting safes, and then walk away with a sample tool that we all can use for building our own models, both as utilizing the tool, but also a reference tool to kind of build your own kind of cap table as well. So first, a disclaimer, nothing here is financial legal advice. I'm not a lawyer. I'm not a financial advisor. I'm not offering financial legal advice. I have biases. I'm an angel investor. I've invested in companies and funds. And so I have biases from that perspective as well. But my goal is to go into all of the details in terms of how to understand this from a mathematical perspective, trying to understand the terms associated with this. There's some things we can cover today. There's a lot of things we can't cover today just because of the time frame. So what we're going to focus on is an overview of the structures, talk about safes, how to raise rounds of capital through safes, how to convert safes into shares through an equity round, how to calculate share prices for conversions, and how to understand the difference between issued outstanding and fully diluted. That's the kind of a core kind of goal for today. Things that are a little bit outside of what we can do today: strategic or legal questions about raising rounds, capital structure of rounds, those sort of things, staying away from that, setting valuation, equity rounds, convertible notes, issuing option pools, warrants, proratas, anti-dilution, recaps, handing out tokens, exit waterfalls. Those are all things that are going to have to be outside the scope of what we can kind of cover today, that we can cover in other ways. So when I first started getting used to learning about, I'll take a step back. First time I built a cap table was when I was working just started working as like a part-time CFO for a company a long time ago. And the first cap table I built for the company and sent to their investors came back with a response being like, basically like, this is all wrong. You don't understand how to do this. And it was right. I had made some kind of fundamental misunderstandings, and the investor kind of clarified like, hey, here's some things that you did completely wrong. And what I learned from that, and so ever since then, I've been spending more time kind of building out better tools to understand cap tables. But currently, the kind of best version of that right now is available online. It's a template you can download for free, used by thousands of people to try to understand how to model cap tables, which some of you have probably already seen in the past. But it's kind of like the current best model that I use to model out cap tables and exit waterfalls. Now, fundamentally, there's many ways of about cap tables. The way I do it is just one of many. You'll see tons of different examples and structure out there. There's tons of other templates, other examples of things to use to understand cap tables. And that's kind of reason that, and I fully believe that like you have to be careful in utilizing cap table templates because they can cover certain situations, but not always everything. And it can be hard to build a tool that kind of covers all the situations that exist out there that isn't overly complex for the current situation you have to model. So what I try to focus on this concept is mechanics and tools. It's kind of the most important thing to me. I'm sorry, the concepts, and understand how to apply the concepts for a specific situation and lay it out however is necessary for kind of what you're looking to do. So first off, what is a cap table? So a cap table for me serves two main goals. One, it's a list of securities that are issued by the company, who owns them, how many shares, what type of shares do you own, those sort of things. And then secondly, it's an analysis tool to understand the impact of financing rounds. And this is like the two different kinds of cap tables. One, like a pre-financing cap table, which focuses on the existing classes of shares and the ownership per investor. And then a pro forma or post-financing cap table, which focuses on what the cap table looks like after a financing. So there's a set of important information on a cap table: shares, totals by different classes, issued outstanding, fully diluted shares, options, safes and convertible notes, a couple of different ways in which they may or may not appear on cap tables, share prices, ownership percentage. Those are important sets of information that are going to be on there. I don't want to, I want to make sure we focus on safes, but I want to cover some basic foundational things around basic cap table math, just to make sure that everyone's on the same place in their learning journey about cap tables. So a couple of kind of basics to kind of make sure we kind of understand. Basics understand pre-money valuation. So pre-money valuation is just what a company's worth before a financing round. Post-money valuation, what a company's worth after a financing round. And it's very simple to calculate. Pre-money valuation plus the amount invested in a round equals a post-money valuation. So the share price is the price per share that investor is paying to purchase new shares to be issued to that investor. Share price in general is just pre-money valuation, basically how much the company's worth, divided by the number of shares that exist prior to the funding round, right? And so that when you figure out, okay, well, how many shares does an investor get? Well, it's, the amount they're investing divided by the share price. And raising money typically means that we have to issue new shares to the investor, which increases the total number of shares and dilutes existing shareholders. And so like that, understanding that kind of flow there is, what's the value of the company? What's the share price of the current shares that are out there? How many shares do I have to issue to the new investor to give them new shares for the amount they're investing? And then how does it change the overall number of shares in the company? That initial flow is fundamentally what we're trying to kind of accomplish here. So there's two major kind of concepts that are kind of embedded within this. One is the idea like raising a round. And raising a round just means that we're taking in investment capital using one of the structures we're going to cover and giving investors securities at a determined price or the right to purchase securities at a price later. Now, rounds can be amorphous. And I say this because there's a lot of different ways to express what a round is. Round doesn't have to be every single investment vehicle you have. It doesn't have to be every single thing at one point in time. Equity round is usually like, hey, I brought lots of investors. They bought a bunch of shares. This is the one thing that happened. With safes and convertibles, it can be a little more fluid. You can take in multiple safes over different valuation caps over a longer period of time and kind of group them under one round. It becomes more of a point of using the rounds to talk about the narrative of what you're doing rather like a discrete definition of hey, here's the round. Now, opposed to separate from raising a round is converting investments. Now, convertible notes and safes, they're converted into equity when the equity round is raised, when the convertible converts into shares, purchasing the same or purchasing shares as the new equity investor with the same rights as their shares, but usually for a different price. And that lower price, the different price they pay, the lower price, is their reward for investing earlier and bearing more risk. And so, everything we're using in terms of using the structures around safes to figure out how much lower price they pay. So there's three basic structures for raising capital: equity, convertible notes, and safes. I don't want to talk too much about equity or convertible notes because I want to focus on safes, but there's some additional kind of background detail here. So there's two major types of safes that we're going to talk about. One is pre-money safe, and the second is a post-money safe. So pre-money safe is essentially treated as a warrant to purchase shares. It's not treated as debt. It was introduced by Y Combinator in 2013, created to be like simpler and easier docs, very standardized to reduce legal costs and complexity, that, to add an additional way to kind of raise capital on top of like the convertible note, which is the typical convertible structure of the time. They can have typically have a cap or a discount rate, no interest rate, no maturity associated with that. They're not debt. There's the second major type is like a post-money safe. The post-money safe was introduced by kind of Y Combinator in 2018. You can go on the website and download all of the actual safe documents and all their kind of conversation on how to use them appropriately. Now, they were created to provide kind of clarity on ownership by defining that conversion method. And we'll get into why that's important in a bit. There is some pluses and pros and cons associated with it. Adding anti-dilution protection to investors, removing pro rata rights, defining liquidation preferences part of it. So there's other kind of aspects to like pluses and pros and cons, pluses and minuses with both structures. So issuing safes are converted into equity when an equity round is raised. So when you issue a safe to an investor, no shares are issued when the instruments are issued. The act of like issuing a safe, the most important point to understand about this is because you're not issuing shares, issuing outstanding shares doesn't change. Like the actual kind of cap table, the number of shares does not change when you issue a safe. Only changes, the estimate of fully diluted is the one part that does change. The actual number of shares doesn't change until the safes actually convert. So what's fully diluted mean? So issued outstanding is like the actual number of shares owned by investors that are owned by the different kind of class of shareholders. Fully diluted is an estimate of more like an estimate of the total number of shares if all of the things out there, all the convertibles and all those things convert into shares at the set of terms. Now it's often an estimate, right? This is going to capture like options, or options can be taken, or what price of the convertibles or safe can be converted at. So it can vary depending upon the future. So when figuring out the future, the key comes out of calculating out the conversion. So you've issued a safe, you have a bunch of them out, then you have an equity round that happens, you have to calculate the conversion. Most important thing to understand about converting safes is to understand who bears the dilutive effect of issuing the new shares, the investor and the convertible. And there's a couple of ways to think about that. The act of issuing new shares to of the convertible, that dilution can be borne by all shareholders, including the new equity shareholders investing in the round. It can be borne by only existing shareholders prior to the round, or it can be some mixture of the two. Now, legal documents associated with the safe will typically specify how to calculate the share prices. How it calculates the share prices, that's the specific way it says, hey, here's how to calculate the share price. And that is, in effect, what determines who bears the dilution. And we'll get into specifics on that. Now, conversion itself should always be evaluated in concert with valuation, right? In the sense that, how a safe gets converted can be negotiated around at the same time as valuation, because there's a couple of ways to look at this. One example is like, take one example. Like, say you have a $3 million safe at a 17 million pre-money. I'm sorry, a $3 million new equity investment coming into a round with a 17 million pre, and you have 2 million of unconverted convertibles. There's basically two variants of ways how to convert them for pre-money safes, for example. You can either say, you can do post-money conversion, where 3 million is coming into like a total of 20 million, and the 3 million investor is going to get 15% expected ownership. The other method, and using the pre-money conversion, the post kind of like floats up, and so they get less, they get a smaller ownership share. Now, you could set the ownership share the same if you just change the valuation. You reduce the valuation to account for the convertibles, the investor can enter the same way. So you have two different methods of doing the conversions, but it can result in the same thing if you think about the fact that like how you convert it is treated in concert with valuation. Now, how do you convert a post-money safe? Now, the way mechanically to think about converting a post-money safe is treat it as where you convert the post-money safe first before the round, using the cap or the discount rate, whatever the terms are, determine how many shares it convert into. So first convert the safes, then issue the equity. And by structure, the dilutive impact of the safes are borne entirely by the existing shareholders, which is typically founders and management companies or any other investors may be part of it. Now, pre-money safe has a little more flavors to it. So there's multiple methods that can be used to calculate the conversion. You can say the conversion occurs at the same time as equity issuance. right? You can say the pre-money method, often called like the founder-friendly pre-money method, using post-money conversion, also called founder-friendly. Percentage ownership or post-money method, pre-money conversion, called investor-friendly. Or you have this method called the dollars invested method, which kind of a mixture of the two. We'll get into the mechanics of them, but the difference between the methods fundamentally is who bears the dilutive effect of issuing convertibles or converting the convertibles into shares, and how much dilution they bear. Now, the terminology around the conversions can be torturous and confusing and exclusionary and obscure and hard to understand sometimes. Right? You can see the same thing called different ways, and it's kind of hard to understand exactly how it works. So you'll see oftentimes I'll call like things like founder friendly and investor friendly, and what I'm basically referring to is who bears the dilution. So under like a pre-money method, which is done through a post-money conversion, otherwise called founder friendly, the price per share of the equity is calculated using the issued outstanding shares. The price per share of the convertibles is calculated from that. And what that does is this spreads the dilution impact of the convertibles across existing shareholders plus the new equity investors, right? That's the founder friendly. The founders don't get crammed down by the conversion, by the dilution happening from the convertibles. The percentage ownership method or the pre-money conversion or the investor friendly option works differently. The fact that the full dilutive impact of converting the safes is borne by the existing shareholders. And that's done because you calculate the price per share a little bit differently. You calculate the price per share of equity by dividing the pre-money by the issued outstanding shares plus the shares issued to the convertibles. And this makes much more sense when we actually dig in the spreadsheets. So I want to talk about the concepts now, but it makes a lot more sense once we get into the math. The other method, which is more rare, is the dollar invested method. Basically, what this does is it kind of splits the difference a little bit, not directly, but it shares the dilutive impact across those two methods by only forcing some of the dilutive impact of converting the notes onto existing shareholders. Some of the dilution is borne by all. I won't get too detailed into that one because I want to focus on the other kind of methods more importantly. And from a practical perspective, I kind of said this before, like the terminology around pre-money and post-money is very confusing. So I like to focus on investor-friendly or founder-friendly, or explicitly state who is bearing the dilution as part of it. There are these like three methods that are used for kind of pre-money safes. It's also just common to convert them where all the dilution is borne by existing shareholders using the pre-money kind of conversion we talked about earlier. Most importantly, like you won't see these methods named in a legal document. The document won't say like use this method basically. Instead, what you'll see is a definition of what shares are included in the calculation of the safe price, and specifically the company capitalization. And that's the part that impacts dilution. So it comes down to like how you calculate the denominator of like that fully diluted shares that is used to calculate the share price. That is what's different between the different conversion methods. And so when someone says like, hey, how do I calculate this sort of thing for a safe? I always say like, read the legal docs, because we have these like specific methods we have, but it can vary by like what the actual legal document says. So always kind of true back to what's the legal document for the safe? How does it calculate it? Use that calculation. So for a lot of these documents, looking at actual documents. So you can go to Y Combinator, they have all the post-money safes, all the details there. You can download all the examples and see exactly how it works. And so I want to go through a couple examples around them. The most important thing when you look at these documents is basically around definitions of some key terms. Now there's a bunch of other terms that define a bunch of other things around the safe. I want to focus on just the math of handling cap tables. So the key terms that I always look for is, one, the purchase amount. That's pretty easy. It's, the amount being invested in the safe. The standard preferred stock, that's the stock that's issued to the new equity investor at the time when the equity round is raised and safe converts. Then there's the safe preferred stock. And that's the stock issued to the safe investors when safe converts. Now, typically they have the same rights as the standard preferred stock, but typically it's explicitly written and it says, hey, the safe preferred stockholders have, substantially the same rights as the standard preferred stock, but they have different liquidation preferences associated with them. And the reason for that is, if a standard preferred, so say a new equity investor coming in and buying at $1 per share, and their liquidation preferences attached to that as $1 per share in general, in most cases. Now, for a safe, they're typically paying a lower price, right? So because they invested a cap or a discount rate, whatever terms, to allow them to benefit to purchase these shares at a lower price, maybe they're paying 80 cents per share. We have to make them different shares because they have different liquidation preferences. Even though the shares are purchased at 80 cents, we don't want to give them a liquidation preference of $1, the same equity investors got. So we define them as a separate share class so we can define differently for liquidation preferences and anti-dilution. It's an important kind of distinction between the two. That's kind of doesn't really play into the cap table per se in terms of like mechanics. Definitely plays into like when we're doing an exit waterfall and showing the proceeds to different investors, because that's when we really care about making sure we use liquidation preference as part of it. The other kind of key term that I always look for is the safe price. So if there's a valuation cap of the docs, the safe price is the price per share paid for the safe preferred stock. It's typically defined as the valuation cap divided by the company capitalization. Then there's the discount price. Like if the docs have a discount rate associated with it, the discount price will be the price per share paid for the safe preferred stock, calculated using the discount rate. And it's usually just saying, hey, safe preferred stock times the discount rate. One thing that gets confusing around the terminology around here is, in common parlance, we'll say, there's a valuation cap and a 20% discount rate. The actual legal docs won't say 20%, they'll say 80%, right? They'll say 1 minus actual discount rate. So the calculation is just like, hey, we 1 minus the actual discount, the safe preferred stock times the discount rate the docs say. But how we commonly talk about it is 1 minus the discount rate what the legal docs say. The math is actually much simpler than it sounds, but just it'd be super clear to get surprised in terms of the way that discount rates in the actual docs different from how we talk about it. The other kind of key terms I look for is like the company capitalization, which is basically how to calculate the number of shares used in calculating share prices. Effectively, that's the idea of like the pre-money valuation divided by the number of shares. Well, what number of shares are used as part of that calcs? And we'll dig into that in more detail in a second. The other one is like the idea of like the equity financing event, usually one of the first terms in there. And this term will basically say like how the safe gets converted to shares. And it'll typically say something like, if it's a safe with a cap, it'll basically say something like the first part of this, which is the purchase amount divided by the lowest price per share of the standard preferred stock, or the purchase amount divided by the safe price. Basically saying, hey, we're going to take however we've determined we calculate the safe price, take the minimum of that or whatever the standard preferred stock is paying. So, or if there's a discount rate, I would say the purchase amount divided by the discount price. So that's the number, that's how it specifies how the number of shares you get from the safe. And there's also things around how it defines like liquidity event, how the safe is treated in a liquidity event. If there's a liquidity event before conversion, I don't want to get the details of that, but typically like, hey, if the shares don't actually convert into shares, what do you do? Well, the safe will say, what do you do? And we just have to follow the rules of the safe. Now, the key term that I want to kind of cover through here is this like company capitalization. This is the term that defines how to calculate share prices. And what you have to look for is how it's worded differently between the documents. It only applies to safes with caps. So here's a couple like specific examples to kind of show you how it's done. So this is a pre-money safe with a valuation cap. This is from the old Y Combinator pre-money safe. And so this is how this is a common way of defining company capitalization. And what I look for here is I'm looking for these terms to say, hey, what do I actually include? It means a sum of all these shares. So the key here is basically it's going to say all shares of capital stock, issued outstanding, all outstanding vested and invested options, warrants, converts, all those things. But excluding this instrument, excluding all their safes and convertible promissory notes. And it's basically saying don't include the shares that come from other safes as part of the fully diluted number of shares. And then also include all common stock available for grant under equity under granting for any equity incentive or option plans, and any equity incentive or similar plan to be created or increased with connection to equity financing. What that means is if there's a new option pool being created as part of equity financing, that the number of shares created for the option pool is included in the fully diluted number of shares that's used to calculate the share price. Now, that's different from a post-money safe, right? So a post-money safe, same basic thing, how to calculate company capitalization. I took this directly from the actual kind of documents online. Includes all shares of capital stock issued outstanding, includes all converting securities, all issued and outstanding options and promised options, includes an unissued option pool, except for any increase in unissued option pool. So the two important parts of that is the latter one's actually easier, is an easier one to start with. The option pool basically says any new option pool that's created as part of the round is not included in the calculation of the share price. And that's because we're going back to what we talked about before. You think mechanically about converting a post-money safe by saying the safe converts first, then you have the round. So if there's any increase in the option pool that's part of the new round, well, that's not included in part of the safe. The second part that's important about this is this includes all converting securities. And this is the aspect that gets people worked up sometimes when I think about post-money safes. Because what this means is it means you actually account for the number of shares that that come from this safe plus any other safes as part of this. Now, this is the part about like anti-dilution that kind of comes up in conversations. The default YC safe, basically, because of this language, it provides anti-dilution protection to safe investors. So, for example, like the idea of the post-money safe is it provides clarity to investors to know what they own, like a certain percent of the company when they get the safe, right? So I say, hey, I'm investing a certain amount of money and I get 5% of the company. The pre-money safe, you may not get that because the actual amount you get is going to vary depending upon what the terms of the conversion are, depending on what the actual kind of valuation of the company and the capital, those sort of things. The post-money safe, you're getting 5%. And not only that, you're getting that 5%, even if the company raises tons more money, right? So you're getting that effective like anti-dilution protection from other safes being raised kind of after this. And that's the part that gets people to kind of talk about, well, is this right or not? I have links in here for some more kind of context to read some of more details about it. But one of the things that people often do is they say, well, let's change the docs. Let's alter the language in terms of how that's done so that the anti-dilution protection doesn't occur the same way. And this is from an example. The URL is in there in terms of like a different way to kind of write this. And all they did was change one aspect of this calculation, which says includes all converting securities outstanding as of the final closing at safe financing, but expressly excludes subsequently issued converting securities at different valuation caps. Now, what that means basically says, hey, you get your 5%, but if we raise more money through more safes, you're not getting anti-dilution protection off of anything raised after that point. And so mechanically, this changes the way you have to calculate the actual safe prices in our models, but it has a very different effect in terms of how in terms of how the dilution part of it works. Now, I'm not saying which one's better or worse, right? My goal with this is just to show you a couple of different examples of like how this term can be worded in different safes. And then when the model will show how it actually gets used, when the example model will show how it actually gets used. But I want to bring this up to say, hey, this is one of like the most important parts of the terms of a safe to understand, because this is basically the safe documents will say, hey, this is how you calculate it. So then our goal is to actually, when we build a model, is just to use and do it exactly the way that the documents are specified. But as founders, we have to understand why this term matters and potentially to change it to address kind of whatever we want to, whatever our kind of goals are with our rounds. So it's an important term to understand. It's a very kind of important part of this. And again, like I'm not a lawyer, there's not legal advice. Work with good lawyers and counsels because there's a number of different ways to kind of do this sort of thing. There's a number of ways to change these terms and slight differences for situations. And that part kind of does actually matter. So I'm going to pause, put on the slides, pull up a model. If any people has any questions so far, go ahead and start kind of dropping them in there and I'll see what I can do to start answering things as I kind of go through the model. Let's see here. So this is the spreadsheet I'm going to kind of utilize. This is available at, if you want to access and do it on your computer right now, it's foresight.is/cap/safe example. I'll put that in the chat as well as a reminder. You can copy this to Google Drive or download to Excel. There's a number. After the session, I will update this with a link to the replay, and I will be recording some additional videos to kind of cover some of the example sheets. So there'll be some more kind of content to come on here. What I've basically broken this out is a number of different sheets which focus on different parts of mechanics, both pre-money, post-money SACE, valuation cap discount rate, how to apply in different situations. And I have links like a bunch of different like background readings that I think are helpful to understand other kind of things around this. There's tons of things online about understanding all of this stuff. So these are kind of a few that I like. But the real goal is of each one of these sheets to be kind of like an instructional tool. And these additional videos will dive into more details around the actual kind of each one of the sheets and explain them in more detail and context that I can't do over like a short kind of workshop like this. So first example is basically a simplified example around a pre-money safe valuation cap under the founder friendly conversion option. All of these sheets have the same kind of basic structure. So a pre-financing cap table, which has, the classes of shares and columns going across, the shareholders going down in rows. And then I have here a section, which is the pro forma cap table showing the issuance of a safe. And then I have a separate thing, pro forma cap table showing the issuance of an equity round and the conversion of the safe. Now, mechanically, this section here doesn't always need to be in this kind of structure. It's also common just to have, hey, here's the pre-financing cap table, here's the post-financing cap table, and have the details around the safe, like the investments, the cap, those sort of things. To have like a separate table below the cap table, very common. I think it's personal preference in terms of how you want to mechanically lay it out. I like doing it this way because I can see everything going across. It's easy to create a very easy structure. It's easy to add more safes. You just add one line and copy the formulas down rather than kind of doing it in one section of the table here and then doing another section there. Less moving parts is a little easier, and I like seeing them flow across. But there's many different ways to do this. The other kind of things that I want to point out is how I break out the different kind of share classes. So here we have common shares and preferred shares, and then here I'm breaking out the preferred shares being issued. The preferred safe shares issued, preferred stock shares issued, the common shares and total common shares, total preferred shares, and total shares. Gordon, the link to this is in the chat directly above you. Oh wait. Oh, interesting. I actually put this in the chat, but I put in the wrong thing. There we go. Sorry, I actually put in a link, but I didn't share with everybody. I apologize. So this is like and then you'll see like this is like the total share counts, and then I do percentage of shares issued and outstanding, fully diluted shares, issued and outstanding. Now, the reason why I'm kind of showing the details is I want to be very specific in showing how the change in total number of shares changes over time, and then how the ownership percentage changes over time as well. And so important to show like how we're issuing new shares, how dilution ownership also affects it. So here we're starting off with a pre-financing cap table, 10 million common shares owned by the two founders. And we have two investors investing under a safe that only has a valuation cap. So this is the amount they invest. These are the caps on their safes. And then, so the slides link, it's actually, the slides link is in the README in the spreadsheet. So it links directly in there. If you have a link to the spreadsheet, you have a link to the slides. So the key thing here is we have the investments being issued, no shares being issued, so no change in issue and outstanding. And then we have an estimate of fully diluted shares. So we have an investment round coming in, but there's no pre-money and post-money valuation, no price per share, no change in total number of actual shares. But this fully diluted count changes. And what this fully diluted amount is like an estimate of, what the shares are going to convert at. Now, you might say, like, how do I calculate fully diluted if I don't know, since the price is based upon a future thing I don't know, how do I calculate it, what I should do? Typically, you will just estimate it based at the cap. So this formula up here, what it's saying is there's a simple calculation here saying, hey, how many shares are going to issue? Well, how much am I investing? which is that first part of the formula, divided by what's the share price. The share price is just the cap divided by the total number of shares prior to the round. So that's what this is. This is 8 million divided by 10 is the share price, 750K divided by 80 cents total number of shares. Same thing for the next investor down, but they have a different cap, different share price. 12 million divided by 10 million divided by 1.2, total number of shares that are estimated to be issued. So that's our fully diluted estimate to kind of understand what ownership would look like on a fully diluted basis. Now we have an equity round being raised. So we have a new investor coming in, putting in $1 million at an agreed upon pre-money of 20 million. Now, the key part of this is using the founder-friendly method is how we calculate the share price. So this share price, we're just saying it's the pre-money divided by the total number of shares that exist prior to the round. We're not including the convertibles as part of this. Our estimate of fully diluted, not included in this. So it's just this pre-money divided by the 10 price per share. So then the new equity investor, they get, their amount they invested, $1 million divided by 2, 500,000 shares. Now, for the conversions, it's a little bit different because we have to calculate their share prices. So in this case, all this formula does is like this. It's like a test. This either says, hey, either do the price of the cap or do the minimum of the price of the cap or the price paid by the equity investor. So for example, like if they paid, if the pre-money valuation is 40, the new equity investor is now paying $4 per share. These are the safes are not paying any higher price because because there's a cap placed in the valuation. Let's say the valuation was 5 million, where the new investor is paying 50 cents. Well, they're not going to pay 80 cents per share. They're going to pay a less share price because whatever gives them the most number of shares. So this min test provides for that in the case of a valuation less than the cap. So you have the number of shares being issued to the safes, number to the new equity investors, and you get a total number of common, total preferred, total number of shares, total issued and outstanding, and then fully diluted. In this case, there's no unconverted convertible, so fully diluted is the same. Great. So then I have the example of let's take an example of the pre-money safe. In the case of the investor friendly. So in a case like the investor friendly option, we have a same basic situation, same basic setup. But in this case, the calculation of share price can be a little bit differently. So in this case, the share price is going to be the total number, it's the pre-money valuation divided by the number of shares prior to the round, plus the number of preferred shares that are issued through the convertibles, right? So we're doing the same calculations to figure out how many shares are issued to the convertibles, but we're doing the number of shares prior to the round E16 plus number of preferred shares is the total calculation. So this effectively reduces the share price, effectively reduces the pre-money valuation that's being given to the founders and forces the dilutive effectivation of convertibles onto all the existing shareholders. And so, that's this lower share price is what accounts for the changes, the kind of dilution associated with it. And the same number of calcs kind of going throughout here, through the number of shares, things over time. Now, this next sheet is the same basic idea, but what it does is it builds in an additional level of complexity built into the model itself, where the choice of how it gets converted is a dropdown, basically. So I can say, well, I can make it an option in the dropdown to say which one am I going to use, and a couple of calculations change to reflect that. The other thing that's different here, that's added in here, is about rounding. So rounding is one of these things I don't always do in very simple models, because it's something that it really only matters when it comes down to an actual, the actual end of the deal, signing off the actual number of shares as part of this. And what the rounding kind of means here is there's two aspects of rounding I'm kind of covering here. Is one, do I round the share price, and do I round the number of shares? Meaning, so number of shares first. Generally, we don't want to create fractional shares. So hidden under all these is these number of shares. It's not actually 588 and 542. It's, there's decimals kind of afterwards. And so we don't actually want that to actually happen. All docs are be written, so there's no fractional shares, there's not a decimal number of shares associated with it. So you have to round off the number of shares. So typically sometimes it's hard coded in there, but for like generalized tools, I try to make it so that it's an option. So we can choose to select whether we round, and then what number of digits number of significant digits we round to, basically what number of decimal points. With shares is typically you don't want any fractional shares, you round to 0 digits. Share price can be different. Doc's going to say you're going to round the share price up to 3 digits. You say you're going to round to 5 digits. You say round to, I don't really see 0 digits, but there's different ways to kind of approach that, or it can be just not rounded. And so the same option there is built in for rounding for calculating share price as well as calculating that. Rounding is in part of like all the other kind of sheets as part of this. And what we're doing there is we're rounding off the number of shares, and then we're actually recalculating the actual investment. Meaning like if we have to round the number of shares up like 1 share, we're going to recalculate the actual number of investment, so that the actual investment amount may change very slightly, depending after like all the end of the math. And so, that's why it can be like little difference in share counts in terms of our share prices between models, depending upon whether we're accounting for fractional shares or whether we're accounting for rounding as part of it. In generalized understanding how cap tables work, I don't think it's not important to do all the rounding part, but when it comes down to like creating the actual cap table at the end, it is kind of useful and valuable as part of that. So this is like the pre-money safe. The important part about this is that this example, the choice of the conversion is, or the method used for the conversion is just like an option here. So the next kind of pre-money safe option covers the same thing, but only using a discount rate. So in this case, there's no cap, there's just discount rate. And this one, like the case is a little bit simpler. We use the same methodology kind of cover before to calculate the share price. The key is the price per share is just the share price times 1 minus discount rate. So we're using a slightly different method for that. Now it gets more complicated when we have situations where have both cap and discount rate, right? So in those cases, we have to do more tests. We have to calculate out what the share price is in both situations, and then calculate out what's going to be. Hold on 1 second here. So you might sound like a bunch of like different errors there. That's a reflection of the fact that like a lot of these calculations require kind of circular references. So if you pull this in your Excel or you using Google Sheets, a lot of calculations, because one thing is calculated from something else that's calculated, there's like a circular reference kind of embedded within there. Excel or Sheets will kick off like a warning saying like this doesn't work. Not true, it does work, right? It's just that the algebra is too complicated to kind of embed within the formulas, and so we have to use circular references, use iterative calculation as part of it. So just turn on iterative calcs in Excel, turn on iterations in Google Sheets, and the model will kind of fundamentally kind of work. So that's kind of one of the core kind of things to cover there. So in this case of the pre-money safe cap and discount, it's the same basic thing. The only difference is the price per share is a slightly more complicated formula, but all it's doing is just testing. It's just saying, hey, what's the price per share if I calculate it using cap? What's the price per share if I calculate it using discount rate? Which one's less? Whichever one's less, where we're paying a lower share price, use that as the price per share in terms of calculations. The other additional part that's built into this that, because this is a shortened version of a much longer kind of topic, and, trying to, cover a set of things here, kind of condensed, not digging into the option pool stuff. But I have the calculations in here as part of it, because how you handle option pools is an important part of understanding in terms of how to calculate share prices. And so this kind of stuff here, which I think is probably best covered by additional videos, basically says how do you handle an option pool, creating an option pool as part of the equity round. How do you use that in part of calculating out the pre-money safe? I don't want to go into too much detail about that because that'll be better covered by the extra videos. Also because I want to talk about post-money safes. Now, post-money safes calculation is a little bit different. Same basic setup, pre-financing cap table, pro forma cap table, show the issuance, pro forma cap table, show the issuance equity round, and the conversion of the safe. The important part about this is how we calculate this estimate of fully diluted and how we calculate the share price. So this fully diluted number of shares has this little weird calculation. It's the same calculation as before, right? So, but what it does is one little extra bit that's different. So it's the same purchase amount divided by the price per share, but it adjusts the price per share to account for the dilution of all the safes in itself. Meaning there's this external calculation out here which says, hey, how much dilution happens from issuing the post-money safe to A, how much dilution happens from the post-money safe to B? What's the total dilution that's part of it? And so we're in this calculation of fully diluted shares, we're adjusting for the dilution of that safe plus any other safes. And so adjusting out for that, such that, if I go in and, saying how much is my, what is my estimated ownership percentage when I invest, right? 750,000 divided by 8 million, I expect to get 9.38% of the company. If I didn't adjust for the dilution, I wouldn't get 9.3% of the company, right? I would get probably 8 point something, 7.8%, for example. But once I account for the dilution, I issue more shares to account for that. I get that full 9.3%. This is the aspect that's part of this is the important aspect that defines how post-money safes are calculated differently. That it creates that anti-dilution effect as part of it. That's the most important part to understand. So this price per share here is basically the same, but there's no, in the pre-money safes, so there's different methods to convert them: pre-money, post-money, whatever, founder-friendly, investor-friendly. And this one, there's one way to convert it, right? And so embedded within this calculation is this calculation of the share price, which basically says, okay, pre-money valuation divided by number of shares prior to the round, which is the same 10 million, plus how many shares were issued to the safes. So we include that calculation in the total kind of fully diluted share count. And that's how we calculate the share price for it. So that's the share price that's used for the new equity investor. And then we calculate out the price per share for the post-money safes using the same kind of structure I had before, right? So it's the cap, this is like a test. And it's built this way to basically what happens if there's like if there's like no cap, basically. But it's doing a test. This calculation is the most important part to it, which is the same. What's the cap divided by how many shares prior to the round times this percentage dilution, or 1 minus the dilution, right? And that's it decreases the share price such that the total number of shares is going to come back out to this full kind of percentage. So the result from this is we have the preferred shares issued is the same here. They get their 9.3%, their 8.3%, but then they get diluted from the issuance of the equity round. And so at the end, they end up with like 8.9 and 7.9%, whatever. But the most important part to this part is and this is where it kind of comes into the idea of like the dilution. So this equity investor, they're investing 1 million into 20 pre or 21 post. They're expecting to get 4.7% ownership percentage at the end of everything. And in this case, they do, because the dilutive effect gets pushed into the existing shareholders, meaning the common. So they think they're getting 4.76%. They're getting 4.7% at the end. In the pre-money example that I showed earlier, if you then under the investor-friendly option, same thing happens. The founder-friendly, they're going to invest thinking they get 4.76%, but they're actually going to get 4.38%, whatever, right? With a slightly kind of lower amount. And so that's the part that shows their dilution as part of it. So there's the other examples here cover the same post-money safe for a discount rate, as well as another example to show both the cap and the discount rate as part of it. But before I try to kind of dig into all the details, I'm going to kind of pause to answer questions. I know there's a lot to cover. And the first question in Q I'll cover, this thing I'm covering right now is all the sessions as part of like the paid course is like an hour and a half. So it's a longer time period and a short amount of content kind of covered within them. So short answer is yes. And then I do office hours and other parts of that. So there's more space for questions for a lot more stuff. So it's very different. But I want to pause for other kind of questions as before I do anything else. No other questions? Nothing else? And there's a question in the chat I see. So estimated fully diluted shares for the second safe, the higher valuation cap. I think this is referring to the pre-money cap, or I'm sorry, pre-money safe. Why isn't it calculated the 10 million shares plus the estimated safe shares from the first safe, the lower valuation cap? Because let's go back to the definition of how the pre-money safe is set. So this is the actual kind of definition on how you calculate the pre-money safe. So all shares, all outstanding vested and unvested options and other convertibles, blah, blah, excluding this instrument, excluding all their safes, and excluding convertible promissory notes. So typically the terms will say to exclude other safes that are part of it. That's why you don't include the estimated shares in the first safe. Including the other estimated shares, that's the part that would create anti-dilution protection, which is actually not part of the pre-money safe as part of this process. The question here is an inflation considered in this model. I'm not sure what kind of inflation you're talking about, but general no. I guess I'm not sure what you mean by inflation. Sorry. So here's a question. How would you model a blend of pre-money and post-money with different caps and discounts? So interesting, that's a good question. Generally try not to do that too much, right? So try not to have like a bunch of different terms associated with it. It just creates more complexity in terms of the actual kind of model itself. The way you would do that is coming back to the core concept, right? So post-money safe converts first, equity round, everything else converts after that. So you would actually divide the safes up into two areas, calculate the conversion post-money safe, calculate the conversion of the pre-money safes as part of that. The part I think about how to handle that is how you include. So the definition for this post-money safe is this part where it says includes all converting securities. So we have to account for the shares that come from the other safes as part of it. That's probably gets a little messy, but it's possible to do. But in general, we try to stay away from having too many different types of vehicles that convert in different methods, because it just makes everything kind of more complicated for our own math and makes it easy to make mistakes. Yeah, it's the same question I think as James kind of had, right? I don't have a model example for that. Actually, the productized tool, the one I kind of shared at the very beginning, does deal with both pre-money and post-money safes. Although I'll note that I think it's a little dense in how it kind of does the calculations, so harder to understand. And so I will be coming out with a newer tool, which does it more kind of the methodologies I use here, which covers both, but I don't have it complete yet. But there will be a new tool to replace that will cover that, but I don't have it done yet. Seems that safes, one other question, it seems that safes always convert to preferred shares, not common shares. Is that part of the terms, is part of the incentives how safes, a film part of safes operate? The answer is yes, right? So if you go back to like the actual kind of docs, they'll say that the safes convert into preferred. And the idea is that the safes are intended, it's in the overall descriptions of them, but like specific in the actual terms to say like, the goal of safes is for them to be treated as a preferred instrument, right? And so there's all sorts of like liquidation preferences, liquidation of rights, all sorts of things. It's tied towards like purchasing kind of preferred shares. So that's typically a part of it. And typically investors are doing this because they want to buy preferred shares, but so that's usually kind of the structure for it. So yeah. Sometimes investors will buy common shares. I'm not familiar with an example of a safe converting to common. I'm sure it's happened. I just haven't seen it, but I'm sure there's an example of it, but it's generally not part of the goal of it, I'd say. So I'd be derelict if I didn't mention that, so my goal for this was to focus on safes, One of the hardest things about teaching like an hour kind of workshop is that there's only so many things you can dig into, and there's a lot of things you can't cover, especially on like edge cases and things. And so I do have a class that digs into a lot more details around cap tables and covers, saves in more details and all these different sheets, and but also convertible notes and equities and exit waterfalls and pro ratas and option pools, all sort of things that way outside the scope of what they're doing today. But also done in, with more space and time to be able to, dig into some of the concepts more. So my goal for this was kind of expose to a lot of the concepts, cover enough ground so you understand the difference between pre-money and post, and show examples of how the calcs work, and then provide lots more resources and tools to kind of review things kind of later, right? And, I'm always available to answer questions around cap tables. I answer questions about building models and cap tables and things every day. So feel free if you have questions about this stuff in general, ask anytime. I'm happy to answer questions around it. My goal is to, with any education around this, is to make like a topic, which I think is like really kind of hard to understand, even for like experienced finance people to understand some of the specific kind of knowledge in the space around it. So my goal is to help. If you have questions, email anytime. But download the slides, download the example tools, watch extra videos, and don't be afraid to kind of ask kind of questions. I'm happy to help anytime. So I'm going to end the webinar with that today and be respectful of people's times. But I really do appreciate kind of people coming, and I really do appreciate all the help and support. So thanks.